Hello viewers, so welcome to this new episode of SI Conversations, and today I have a very interesting personality. And I have been always told that I don't smile much, but I think this is one video where I'm going to smile a lot, because in life there could be nothing better than a chance when you get an opportunity to interview somebody whom you have kept as your virtual guru. And today's guest, he's somebody that to me, Mr. Abhishek Basumallick. He is founder of IntelSense and QuantMental.in, where he manages money both as systematic investing as well as discretionary investing. So welcome to scientific investing, Dada. We call him Dada Pyar Se. So first of all, welcome.
Thank you, Saurav. Thank
Yeah,
you,
and
kind words.
the journey which goes is like, I think most of you are aware of valuepicker.com. A lot of us, we have built our investing journey, our career, investing career out of valuepicker.com. And Dada has been one of the early members of valuepicker.com. In fact, he's moderator of valuepicker.com. And when I started my journey, it was those threads, those informative videos from the founders of ValuePicker, Dada, Ayush Bhai and all, and learning, going through all that, I did my learning. So whatever knowledge I and many of us we have gained, all credit goes to folks like Abhishek Basumallick, Ayush Bhai, and everybody. So Dada, welcome. And also, let me highlight now, Dada is a full-time investor. He is managing public money. He runs, an advisory firm called IntelSense.in. The other one, which is more on the quant side, is QuantMental.in. And I remember, I think 3 years back when there was a value picker, Chintan Batak, that was the first time when I saw the other side of Dada, the quant side of Dada, and he did some lot of back testing he presented. And I also had similar interest. So, that impresses a lot, because somebody who has been so much successful in a discretionary investing, and how still he is eager to learn, and he shifts completely to a different gear. And, that really impressed me. And I think this hybrid learning kind of thing is which binds, and, uh, because of which I have a lot of respect for him. So today's discussion will be around, these two styles of, the discretionary side versus systematic side, and we will get deeper into it. So welcome, Dada.
Thank you.
So Dada, what we will do is, because not everybody is aware of all these investing styles, so why don't we start with you educating our audience what is discretionary investing and what is systematic investing, and the core differences between each of them?
The basic thing is, it is understood in the words itself. When you say discretionary investing, it means that you are using your discretion, your judgment, your understanding when you're buying or selling a particular stock. When you are saying that I am a non-discretionary or a systematic investor or a system-driven investor or a trader, whichever. So, okay, I'll come to the trader versus investor part a little bit later. But if you're calling yourself a system-driven investor, then what you're essentially saying is you have some system, which could be a written down system, it could be a computerized algorithm, uh, whichever format it may be. Basically you have a step by step process which you are using to do your investing, and where you are not using your discretion, where you are not using your judgment. You're not trying to say that, okay, should I buy this, how much should I buy, those kinds of things. You are using a predetermined system, which you have made or which somebody else has made, and you are using that system to buy and sell.
Okay. And Dada, if by whatever I know your history by following on Value Picker, so for long you have been a discretionary investor. So why did you think even about exploring systematic investing, as an additional investment style? What made you to, look for systematic investing?
So there's two things that happened more or less simultaneously, and I'll if you give me 2-3 minutes, I'll explain both of them. Very interesting story.
Please go ahead.
So the first thing that happened was, my I have a young son who's growing up, and about 3-4 years back, I started thinking that if I have to teach him investing, what should I teach him? Because what I was realizing is I have gone through so many books. I've made so many mistakes. I've learned all, yeah, every day I'm trying to keep learning. How do I transfer that knowledge to him or to other people like him who are young, who are, who might be interested to become, even if they are, doing some other profession. I think investing is something that you should always do in parallel with whatever else you are doing. Or if he wants to be a full-time investor, how do I transfer the knowledge base? Or does he have to start from scratch? Does he have to, start? My first book that I read on investing was The Warren Buffett Way. So does he have to start from there and, study about everything? So I was trying to think that, can I then sort of write down the process? What is my universe? What kind of stocks do I like? What kind of stocks have has made me successful? Have been successful picks over the long term. So these are things that I was thinking. At the same time, I came across a book. I have forgotten now the name of the book. It was very ordinary. I mean, the content of the book was very bad. But the book, on the first few pages, it had a table of long-term compounded CAGR returns for many investors, traders. If I remember the name of the book, I'll tell you. But it's there on the Value Booker thread, which I had written initiating the quant one.
That chart also, and
yes,
you highlighted
yes. So
it's
that
not only
actually,
investor which makes money.
Yes. So in fact, that chart opened my eyes. So what I was looking, because I have, I used to and still read a lot. I was familiar with at least 95% of the names on those charts, whether they were traders or investors or macro traders, whatever, right? And when I started looking at the long-term CAGR, so I started looking at people who had more than 10 years of track record. And what I found was that it was a fascinating journey, because there were lots of people who had a great number of returns which were more than 30-40%, right? So that sort of piqued my interest, that okay, if there are people who are able to do these things, right, who are able to generate such high returns, and when I was looking through it, Buffett was somewhere in the lower end of the table. Buffett at that, I think in that book, was around roughly 21-22%. And you had Richard Dennis. In fact, let me share the. Can I share my screen? I'll show you.
Sure. Please go ahead. Let me just give you access.
But anyway, this is the table that I was referring to. And if you look at the records of some of the people here, Richard Dennis, right, the original turtle trader, 19 years.
19 years.
Okay, 19 years of track record with 120% CAGR. Right, Michael Marcus, 10 years, 120%. So if you just go through these names, and you will realize that you have all sorts of people here. Completely technical traders like Victor Sperandeo, Ed Secota, William Eckert, and then you have Jim Rogers, who's more a macro trader, Stan Druckenmiller, macro trader. And on the other hand, you will have a lot of people who are fundamental investors. Here you have Peter Lynch at the bottom here on the left, Richard Dreyhaus. So what struck me, and Warren Buffett is here, I think 23%. What struck me was that if you look at people who have, you take a cutoff of say 15 years and above, there are people who come with completely different styles, and they are able to generate humongous amounts of return, right? And till that time, I was only focusing on the Buffett kind of style, which was buy and hold and ignore everything else, right? But this particular uh, table forced me to look at other styles and say that, okay, if there are other people who are able to generate sustainably long-term great returns, there must be something, some method in that madness. We just cannot say that, those guys are just doing it on random luck.
Right? 20, 30 years means they have seen multiple cycles and still it has worked.
So even 15 years, which was, what cutoff I took, 15 years is phenomenal. If look at, Ed Seykota or Victor Sperendio, 19 years of 72% CAGR. It's just mind-boggling.
But any reason you see why Warren Buffett is most popular? Because even if I see Walter Scholes, he has been, I think after 53 years, Buffett, he's there for 49 years and almost 20% CAGR, which is like almost comparable both in terms of longevity and return. Any reason you see why Buffett's style of investing is more popular despite of others giving very high return?
Okay, so two things. First of all, caveat, I am a huge Buffett fan. I used to be a bigger Buffett fan earlier. Now I'm slightly lesser, but probably that degree is like, I used to be 100% Buffett fan. Now probably somewhere around 90%. Buffett and Munger are my life gurus. Investment, I think there are other people who are probably better than Buffett. One reason why I think he has become so famous, I mean, a lot of reasons. One, obviously, he is his communication skills. The way he writes, way he communicates is just phenomenal. So that's one part. The second part, I think, is that is just because of the fact that he has made so much money, right? How he has made that money, whether he used a float from business income, etc., that's a different discussion altogether. But just by the fact that he has made so much money has made him famous. That's the way the world works. Elon Musk, Jeff Bezos, they're phenomenally famous. After a few years, you will read so many books on their management styles, simply because they are rich, or they've been enormously successful at what they are doing. If you look at Walter Schloss, he has been a quant investor through and through, right? Walter Schloss is a pure quant investor. These are things which may be sacrilegious for people to hear, but the fact is that Walter Schloss goes primarily by deep value quantitative techniques that Ben Graham and sort of popularized in the initial years of his in his books. Incidentally, Ben Graham, people associate him with discretionary long-term investing. But if you read his books and if you read his interviews at the end of his life, Ben Graham was a complete convert. He at the end of his career, he said that you're doing fundamental analysis is all waste of time. You should actually do quantitative screens, right? So that's where he ended up. Even his investment success was very, very concentrated on one particular stock, which was Geico, right? But I mean, to answer your question, I think it's very important to understand that there are many styles. There are many ways to get to your goal of getting above average returns, and what you should focus on is what suits you, what suits your mindset. I think that is the most important factor. And when I looked at this table, this table actually pushed me towards that okay, we have all been sort of overdosed on Buffett in India, at least people who started in the early 2000s or late 90s, started investing because that only his books were available. It was only Buffett, books related to Buffett that was available in the market. You did not have too many books on or at least not too many books which were very popular from other investing styles or other things that we see today. Internet also, I mean, we didn't have the kind of exposure 20 years back that we have today. So I think a lot of these factors, have sort of, so people who started 20-25 years back are mostly, you will find people who associate themselves with value investing, or slightly later maybe with more of Peter Lynch when he became popular. Last few years you will find a lot of people who are interested in technical analysis and things like that. So these are phases, I think, which come up depending on which style becomes more predominant, or what becomes trendy at that point in time.
Sure. So to the audience, I think this table should be an eye opener. Another thing, in case you are not on Value Picker, please explore one of the best forums. And I think, Dada, you run a thread on quants investing itself, and I've seen there is so much to learn, so many resources are there. So do explore those quants based threads also. So Dada, you said that we should follow the style which we are good at. So now, given you have both the things in the armor, one discretionary investing and the other one is systematic investing. First, in your personal portfolio and of course for advisory, how do you maintain a balance? Like, do you follow both the styles? Have you allocated separate amount of money in both? How do you follow, if you can give something?
So basically, I only think in terms nowadays. I'll tell you, I think in terms of the time horizon. So if I am looking at a longer time horizon of 3 years, 4 years, 5 years, I have a higher allocation towards the discretionary long-term compounding kind of portfolio. Shorter term, I'm looking at more of Techno-funda, more of quant, momentum, those kinds of strategies to derive shorter term returns. Now, the thought process or the mindset has to be completely different for each of these, right? And one way I try to do it is I try to keep it completely separate. So on the days of the week where I'm doing fundamental analysis, I don't look at charts, and I don't look at any sorts of quant systems, and vice versa. So that's one part of sort of mental segregation. Otherwise, it will become very, very conflicting, right? So that's what I try to do. And you have to be very, very clear that, okay, this portfolio or this stock is for my long term, and this one is for quant or Techno-funda or whatever. And even if at one point in time there may be a stock which is common in both, right? You may have a position in a long term portfolio stock, which may also come up in a short term portfolio. And the fun is when it is opposite. So when you have when you're buying and holding a long term stock, but it comes as a sell in your short term.
You are discussing all the things which I have in my questions, so it's very interesting.
So then what you do is then you need that mental segregation, that okay, long term I keep holding, short term I do I trade around that position or whatever. So those are things that you have to look at. The other thing is, everyone, I have seen, I have known you for more than 5 years now, and I have seen you that you are also learning new things, you are also exploring new things, and everybody who's in the market, who's willing to learn, and who's willing to experiment, usually ends up learning something new, right? Every year, every 2 years, every 3 years. Same thing is happening with me, right? I mean, first 10 years I was a complete buy and hold Buffett kind of person. Then slowly started looking at more of growth, then started looking at technical analysis, but again on a longer time frame. Once I started exploring technical analysis, then started getting into more of indicators, more of quantitative numbers, more of quant based screens, those kinds of things. And then you sort of have that end-to-end spectrum of styles. So another thing that I personally believe is markets go through distinct style phases, right? Now, what happens is at sometimes you will see that momentum does extremely well. At other times, you will see mean reversion or value doing extremely well. At some other times, you will find quality doing extremely well. Some other time, you will find growth doing extremely well. So these are different factors. And most of the times, you will not see all of them firing together. You will see one or two factors doing extremely well and the other factors sort of resting. So if you have a multi strategy approach, that okay, you can allocate your capital across multiple strategies, then what happens is your equity curve, basically your returns, get smoothed out, right? You tend to get over a longer period of time, over 10, 15, 20 years, you will get a average of all those returns. So you will not get the best of returns of any one strategy, and neither will you get the worst of the other strategy, right? So for example, in the last 7, 8 years, excluding say the last 1 year, value has not performed well at all, right? But last 1 year value has performed well. So say last 5 years, n minus 5 years, if you have been investing in a pure value kind of focused portfolio, you would have actually done miserably poorly, right? Similarly, last I think 2-3 years, if you have done momentum, you would have done really well. Last say 6 months or last 3-4 months or whatever, shorter period, you would see exactly opposite. I mean, value has done extremely well post COVID or for the last 1 year. Value could actually do as a factor, value could do well in the next 6 months to a year, maybe 2-3 years. So these cycles keep happening even in strategies or factors. And once you have a multi-factor strategy, right, where your capital, okay, you say that I will have 30% in momentum, I will have 30% in value, and I'll have 30% in growth. Then you have a more balanced portfolio. That's the way to look at it.
And I think psychologically, if you see lesser drawdown or if the curve is little smooth, I think it helps a lot, because when you get extremes of great return or bad return, there are chances that either you will become too much confident of yourself, or you'll get too worried. But when it is smoother, the journey stays longer and you believe in the overall equity culture. So that helps.
Absolutely. And see, here what you just said is right for probably 90% or 95% of people. There are a few people who will, who are different, their thought process. So there are some people who are, deep value investors. Now, a deep value investor's mindset and say a momentum investor's mindset is completely different, right? A deep value investor is willing to buy a stock at 100, knowing that it could go to 20.
Yeah.
Right. Whereas if you ask a momentum guy to buy a stock at 100, he will start sweating and panicking if it goes to 90.
Yeah.
Right? So mentally it is very different. And personally, for me, if you ask me, I am most comfortable when I have when I'm sort of traversing the journey where a stock has business momentum and price momentum, right? So the business continues to do well, the stock is continuing to compound, and you sort of ride along with that as a passive investor. You sort of park your capital with the promoter or with the management, and you sort of continue with that ride. If you get the business momentum correct, right? And when I'm talking about business momentum, I'm basically talking about earnings growth. If you can get the business momentum correct, and that business momentum lasts for a while, you can get phenomenal results, right? And I think we've all noticed it in things like a HDFC Bank or an Asian Paints or a Bajaj Finance, whatnot. I mean, these stocks have had business momentum for decades, or at least more than 5 years, 8 years, 10 years. Once you have that momentum, and once you have that business momentum, price typically tends to follow. Once price follows, you have a mega multi-bagger basically in your hands. What you have to do is just get out of the way and let it compound.
So in your discretionary, do you still look at basic technical, or you don't look at, because you have a quants portfolio will take care? So can you?
No. So now I don't have something where I am fully fundamental or I'm fully technical. Even in my long-term portfolio, I use technical analysis. Even in the short-term, hit picks or moment positional trading, I look at fundamentals. Right. So it's never either or. I think the biggest fallacy in our investing, thought process is that when people say that technicals bakwas hai or fundamentals bakwas hai or whatever, right? It's basically our ignorance, right? Because I am unable to understand technicals or fundamentals, I am saying that doesn't work. To me, the way I treat it is everything is information, right? Fundamentals is giving me the information about the stock, about the company, about the sector. Technicals is giving me the information about the demand and supply in the market. Both of that is important. You might have a great business, but if the price does not go up, what good that it's going to do to you as a minority shareholder, right? You will only gain if the stock price goes up. That is the bottom line. In fact, you know this traders, this quote that people say, bhav bhagwan che, right? The price is god. That is actually important even for investors, right? If you have a long-term stock holding, if the price does not go up and you keep holding on to it, what benefit is it going to do?
Dada,
Because end of the day,
side, yeah, please go ahead.
no, because end of the day, dividend yield, which is what ultimately what you're looking for. You're looking for cash outflow, right? To you. You need to make money. So one way it will be a dividend, the other way is price appreciation of the stock. So dividend yield typically is in India is not very high, right? Unless you are looking for specific places which are dividend yield places. If roughly you will get 1% plus minus dividend yield. So that cannot be the aspiration for you to invest in equities. So the only other way is stock price appreciation. Sorry, you were saying something.
Yeah. So Dada, I totally agree on, if even if business is good but price is not moving, it doesn't make sense. But if we take it reverse, there is a group of people who say if you are doing quants, you don't need to look at fundamental, because if you have liquidity and if it is giving you a proper entry and exit, if price is going up, how does it matter? And I don't want to go stock by stock name, but there have been a lot of stocks where fundamentals look poor, but still they became 8 or 10 baggers. So do you think are you okay with skipping
Yes.
those stocks? Or
no. Why should you skip? So you have to start with the objective. Start with the end in mind, right? What is your objective? Your objective is to make money, right? If your objective in the market is to make money, first thing you have to do that. Once you are clear about that, then you should say that I will buy anything and everything, provided it fits into my framework. Now you have to define your framework. What is my framework? So I'll give you my example. So I will not buy companies where there is shady corporate governance or where management is not, management is great. Where where you have question marks, a lot of question marks on the management. In my opinion, in Indian markets, you will probably, the number of companies that have superb or blemish free corporate governance and management, you can probably count with the fingers in your hand, maybe even one hand, right? So you have to factor in the graded, what grade of corporate governance misdemeanor is there, right? So everybody does something wrong or the other. It's just a matter of degree and your comfort of how much degree you are willing to sort of agree to. So that's number one. Second thing, so for me, if somebody does a lot of misdemeanors in corporate governance, that is probably a no-no for me in my systematic portfolio. Okay, now I'm only talking about the quant side, not the long-term side, right? What is more important is your time frame. So if you are planning to use a system that you are going to hold a stock for 1 week, 2 weeks, 5 weeks, 10 weeks, three months, 6 months, and you have a defined exit criteria, then you might as well, get into any stock, as long as it follows your entry criteria.
And does it happen that one system or one style leads to ideas for other, like because you spoke about technical, and again I know you have been an appreciator of technical, though maybe you directly didn't practice it and more from a long term. So let's say we are looking at charts or something comes in quants and we see that the charts are trending and slowly things are turning. Does it create excitement? Okay, I think I should look at fundamental. And has it happened that technical gives you ideas on fundamental side, or if fundamental is doing really well, and that is why you want to take a technical position? To those kind of things occur?
Absolutely. And so the way I personally use it currently is I use both. So sometimes fundamentals, will give an idea, and I look at technicals to sort of fine tune my entry and exit. Similarly, if I see in long term charts, in weekly, monthly charts, some sort of patterns or some indicators indicating, or in my screeners or in my quant strategy, something coming up, I then go back and start looking. This is also very useful when you are looking or when you're screening for industries or sectors. Some suddenly you will find some industries starting to move. Then you start looking or exploring the fundamentals of some companies which you know or like from your personal history. So obviously, I mean, your point is absolutely right. Both feed into each other. Sometimes you will get fundamental ideas. You then start, then look at the technicals and see how they are positioned from a demand supply perspective. And on the other hand, sometimes you will find a technical chart which looks very promising, and then you go back and look at the fundamentals. See, the final objective is, even if you are looking at a technical chart and you find something great, your objective is, for me at least, the holy grail is to find that spot where business momentum and price momentum match up. So if you can find a good technical setup and you find great fundamentals or changing fundamentals, fundamentals changing from poor to good, or from good to great, in that scenario, the longevity of that holding period and the longevity of the growth that you can get is much longer compared to if you are just doing just technicals or just fundamentals.
Got it. So Dada, we understand that hybrid is something which which is more beneficial. We also understood that the time frame expectation is what differentiates whether you should go for this or that. And the third thing is more about both of them feeding each other. But do you think there could be scenarios where one should not do this or one should not do that? Like if there are any pros and cons of both approaches where one should pick only one, or who should not pick and embrace both, could there be a possibility?
So see, now to answer your question, I'll have to divide this point into two parts. One is people like you and me, who are who devote a lot of time in the markets, and then you have other people who may be doing something else, and maybe just has time to spend a little bit, 10-15 minutes a day just looking at what stocks they have and what is the portfolio doing, maybe buy something, etc. So if you divide that into two universe of people, for people like us who have more time to devote, one is you could try all options, right? Depending on what's your mindset. If you have if you have a very long term orientation, you should look at long term discretionary as well as long term quantitative factors, right? Even the magic formula, for example, just an aside, if you look at Joel Greenblatt's magic formula, it's a quant screen basically, right? It's a quant system, right? There's no human discretion. He's not picking a stock. Every index that we look at, whether you're looking at a Nifty or a Sensex or whatever index, these are all quant system. There's no committee who's sitting and deciding that Nini,
Yeah.
now I have to add this stock into the Nifty, right? There is a formula written. Whichever stocks falls into that formula, you sort and get the top 50, and then that becomes your Nifty 50, right? So the index that everybody is benchmarking against is a quant system. It's an output of a quant system, right? So these are simple things, but nobody tells us these things, right? Everybody, the moment you say a quant system or a non-discretionary system, these things sound very jargon like, and common people say that this is very complex, I don't want to do this.
Yeah.
Right? But ultimately it could be something very simple, right? And also the other thing, that other misconception is that people think that quant means it is technical only. Need not be. Like Joel Greenblatt, I just gave an example. Walter's Claus. These are all pure quant investors. People who are looking at price to book, P, or whatever these kinds of ratios, ROC. You could have a purely fundamental based quantitative system.
In the mind, we always try to do the same. We try to find a pattern and we work it, just
absolutely.
that we don't
In fact, that was the first story I told you, right? When I was thinking about what I would teach my son. It's the same thing, right? I mean, even when I was doing discretionary fundamental investing, there is a pattern in my head, right? I'm just thinking that, okay, I want a stock which is growing, at least this percentage. I want a stock which does not have too much of debt. Promoter holding should be reasonable. So these are things that you're looking for, either knowingly or unknowingly. I'm just saying that you put it down in a process. You put it down in a list and then follow that list.
Sure.
Okay. And I completely forgot what is the question you asked. Your question was who should or should not do it. So I think people who have time can explore all options. Quant is actually a very good way for people who don't have time and who are not that interested. You just take a basket approach and you invest, right? So quant is actually a good option for people who are not very, who don't have a lot of time and who don't want to get involved a lot. Right?
I think that is why Mr. Buffett is a big appreciator of index funds, because like you said, the index itself is a way of quants. And
absolutely. So in fact, in the West now, if you look at in the US, there is a huge, what should I say, trend of something known as custom indexing, right? That this terminology has not even come to India now, right? Abhi to just quant sunne ko aa raha hai logon ke muh se. But the thing is, custom indexing products or custom indexing is not there at all, right? But ultimately, what is custom indexing? These are ultimately screen-driven, system-driven indexes. Custom indexing, because you are, as a customer or you as an investor, you are defining what kind of what kind of index you want to create for yourself, right? So you pick out the factors that I want to do value plus growth, or I want to do momentum plus growth, etc., etc. And then you put in your parameters and you create your index.
Got it. So Dada, these kind of multi-style investing, I believe it's a transition in itself when you start with, because one, there is a learning aspect and there is a behavioral aspect of it. And of course, it looks exciting, but it comes with own challenges. And I think some of them you beautifully highlighted that, you have to keep them separate because the mindset is very different. Apart from that, what are some of the other challenges one could face, in this journey? And what will be your top 2-3 suggestions how to cope up with that?
I think the most important problem is mindset, right? Because when you're when you're a pure fundamental investor, you are looking at averaging down. When you are a technical trader, you have a defined stop loss, right? That mindset itself is completely different. So what will you do when you buy a stock at 100 and it goes to 80, right? If you are a pure fundamental investor, you should add more. If you are a trader, probably it will you'll get stopped out somewhere. So you have to decide what your system is going to be, or you have to go by that differentiated mindset that, okay, this is my fundamental call, this is what I'll do here, this is my technical stuff, this is what I'll do here. So mindset, I think, is the biggest challenge. Obviously, knowledge acquisition is also a challenge in the sense that requires complementary or different skills altogether, right? Fundamentals requires you to understand the industry, understand the company, understand balance sheet, P&L account, etc., etc. Technicals require you to understand, interpret charts. It quantitative requires you to be able to navigate large amounts of data. You should be conversant with Excel or some other programming language like Python, etc., etc. So skill sets are different. You need to be able to learn. I think I was lucky because I had an IT background. So most of us, right? I mean, we were able to do the coding and get started, because otherwise the quantitative part becomes a little bit overwhelming if you're trying to do some kind of indicator, or you're trying to create your own indicators, etc. So that becomes a little bit of a challenge. So these are the primary challenges. The good side is huge number of good material available on the internet, great books available for us to get learning. What is not available is curiosity. You cannot it's not easily available in people. You cannot teach somebody to be calm, to be composed. The behavioral side is not easily available. That is not something that you can learn by reading a book or by looking at watching a video. And to me, the behavioral aspect determines probably 70-80% of your investment outcome.
So Dada, you have been doing both of this under IntelSense and QuantMental. So can you explain in bit, what are the various products or offerings, and on what philosophy they are built?
Right. So basically, IntelSense, we have, I think right now we have 4 products, or basically and I first of all, I'm not usually, I don't talk about what we do in the advisory, because it sort of sounds very self-promoting. But since you asked this question, I'll just briefly talk about it. Viewers are, welcome to just sort of fast forward, move forward. Basically, I have one long-term portfolio where the focus is more on looking at compounding stocks, buy and hold for at least year, 2 years, 3 years, depending on the business cycle. So that's the long-term portfolio. Then we have the Techno-funda based service, which is called HitFix. That is where we do fundamentals plus technicals, where it's slightly more technical based than fundamentals. So fundamentals maybe 30-40%, technicals slightly more, where the effort is to try and capture medium term moves. So 2 months to 6 months is the typical holding period. And third, we have 2 quant strategies. One is multi-cap, which is we call Q30, and one is purely large and mid cap, which is Q10. Both are momentum based trend following strategies. That is on the quant side. And then I have a very concentrated, just small case only offering, which is called Quiver, and it's like 10 stocks only and very concentrated. It uses a combination of all 3. So some quant, some Techno-funda, and some long term. So this is what we have. Next month in April, we are going to start our PMS. So hopefully, again, we'll be having 2 separate fund offerings. But as and when we launch it, we'll sort of have more details.
Got it. And the other, usually the discretionary is more long-term in nature, as you said, and others which are momentum. So of course, when the market, there is no momentum, if it is downtrend, or I think even if it is range bound, the system itself throws you out. So you are there in
Absolutely.
cash. That itself is a good way to deal with the situation. But apart from that, anything else do you try? Like if it's not a momentum market. So is it like a pure, pure long strategy, or there is any component of long short, or is there any way to handle, or that cash itself is a good cushion to deal with the situation?
Yeah, so I have actually done a lot of thinking on this. The problem is I don't use any form of FNO, and without FNO you cannot short in India. So right now the strategies are long only, and if there is no if there are no stocks in that strategy at that point in time, we are in cash. That's the way it's sort of built right now. Have moving to cash itself does give a lot of cushion, especially when the market falls off. But having said that, let me be very clear. Like I said earlier, there will be times in the market when a particular style will be in vogue, and there will be times when a particular strategy will not be in vogue, right? So not always will you get a momentum market, right? And that period you will not make a lot of money, right? In fact, at times you will lose little bit of money. But in a longer time cycle, what you will see is that roughly, I mean, there's a 75%, 25% time spread between bull market and bear market in India. So what I mean by that is, let's say a market goes up for 3 years, then falls for a year, or consolidates and goes downwards for a year. So that is a 3:1 ratio. So 3/4 of the time markets are in an uptrend. So you will make money in a momentum trending system when there is momentum or there is an uptrend. At other times you will not, and you need to understand that when you are getting in. There could be prolonged periods of 6 months, 1 year, 2 years, when in a momentum system you may not get returns. Conversely, there could be a year, 2 years in a long-term based system when you are not making money because markets could be choppy. So that is the nature of the beast. That is the nature of equity investing. Returns here are not linear. At times you will get great returns. At times you will get very poor returns. The objective is that it should, over a 3, 5, 10, 15, 20 year period, you should be making, at least in my opinion, double of what FD sort of returns, at maybe a little bit more than double.
Got it. Got it. And Dada, this is my favorite question. I asked to all my guests. So my question is, like, in this whole investing journey, I think more than a decade, almost 2 decades, what have been your key aha moments? And especially from this whole systematic versus discretionary, what are your aha moments in this journey?
Very, very difficult to answer this question, but lots of aha moments. Right from when I discovered that there is somebody, person called Warren Buffett, and buying and holding stocks, being a minority partner in a business while you are working and while you are getting a salary, letting the money compound. That was an aha moment, right? That you could be doing something else and you could get your money to work with some of the greatest promoters, minds, managements that you can find. So that was an aha moment. So every once in a while, after a while, I sort of realized that this multi strategy also was a great aha moment, right? Many aha moments, I think. I mean, every small thing that you learn, right?
If you keep learning, you will keep getting it.
Yeah, you keep learning. You sort of the first time when I understood that averaging down was not a very intelligent thing to do was an aha moment, right? First time when I understood the concept of a stop loss and why it is required or why it is used, that was an aha moment. The first time I understood the concept of paying up, right? For a good business, that was an aha moment. So lot of aha moments will come as and when you keep learning. I am sure even in the next 10, 15, 20 years of in the future, I will have many more aha moments as and when I keep learning more and more.
Okay. And Dada, you spoke about there are a lot of resources to learn, but the motivation and will, that is something which, which is not available. So in terms of resources, and if I remember, I think one of the early books on quants you only suggested, that was What Works on Wall Street. I mean, it's a very simple book on univariate analysis, but how you should backtest, what metric you should look at. I think that was a very good book. So what are the other resources if somebody is looking at, one, learning about systematic investing, and second, mixing, or better to say using the word hybrid, whether it's pure technical systematic or techno-funda systematic? What are the learning resources, books, blogs would you suggest?
So I, because I get this question so often, what I have done is, if you go to my blog, blog.intelsense.in, I have a link there called my bookshelf. Okay, let me share my.
And meanwhile, Dada is sharing. I think Dada, he comes on multiple business channels. He writes for some of the business newspapers. So I have tried to consolidate some of those links and put in the description box. Do have a look at it.
So these are, books or sources that I have found useful. And what I've tried to do is, and I'll go through some of these. One is, the first thing is, when if you're starting from scratch, you need to build a base. You need to have a foundation of how to think. So, Rich Dad Poor Dad is one of the most influential books that I have read in terms of personal finance. Why you should invest, this will give you that framework of why you should be investing. Then, One Up on Wall Street by Lynch. Most important thing, Howard Marks. Margin of Safety, Warren Buffett Way, Fooled by Randomness. So these are books which will help you have a very sound base of investing, of approaching the markets. Some of these books will help you, in fact, in terms of how to approach thinking. Then you have a lot of great books on the fundamental side of things. So, Beating the Street obviously is a book of case studies, not as popular as One Up on Wall Street, but I think a more instructive book for practitioners. This book is extremely good. 5 Rules for Successful Stock Investing by Pat Dorsey. Then you have a lot of these books. I'll not go through all of them, but a lot of great books, Common Stocks and Uncommon Profits, which is sort of the Bible for growth investing. Then you have courses on valuation from Ashwath Damodaran, financial statement analysis. These are all video sort of courses that you can do for free. Stephen Penman's book on valuation, Ashwath Damodaran's book on valuation. These are good primers. Although I must say that after having read all this, please don't become a Excel sort of Excel junkie and sort of get fixated on DCF and things like that. Please understand that valuation is an art. It is not a science. It cannot be derived on an Excel spreadsheet, right? Like we say, value is in the eye of the beholder, right? So valuation is an art. These, valuation books or templates or methodologies will help you get a sense of how to value, but it's not a spreadsheet exercise. The book, Saurabh, you mentioned about what works on Wall Street. Yeah, it's a fantastic book by Jim O'Shaughnessy of Osam Capital. Great introduction to what you should be looking at in a quantitative analysis. Mark Minervini's books are very, very good from a technical perspective. William O'Neill, Can Slim, again, fantastic. Momentum, I think, Dual Momentum, Quantitative Momentum, these books are decent. Pretty much, I mean, if you are able to go through these books, these are, very, very good resources. And then you have psychology, which I think probably if you are able to go through these, this will take care of 50, 60, maybe 70% of your returns. In my opinion, I could be wrong, but I think psychology is the primary determinant of whether we are able to do good versus great. And what I've found also is that there are a lot of very good trading psychology books. whenever you're reading, just replace the word trading with investing in your mind and read that book. It's just that trading, in my opinion, is a time compressed version of investing. Ultimately, both investing and trading is speculation, right? You don't know what the future is. Anybody who tells you otherwise is basically, sort of, I mean, I don't want to say negative things, but end of the day, all investing, trading is about the future. So it is speculation, right? It's just that the time horizon is different. And then I have a list of other readings, newspapers, blogs, etc.
This is very comprehensive, Dada. Thanks for this. One more question I have. So in all the sections, I think I have read 20, 30, 40% of books. Psychology is one thing where so far I have not touched upon anything, because somehow I have this pre-notion is psychology is something which cannot be taught. It has to be experienced. So my question, what has been your journey? Does reading psychology really helps to build psychology, or you need to practice it to build it?
So first of all, it is like, if you're asking that, does reading, say, the alphabet, ABCD, does it help in, any way? Of course it does. I mean, it will, unless you are aware of ABCD, you cannot read words, sentences, paragraphs, right? Similarly here, if you don't know, if you don't have a background on behavioral psychology, you will not be able to identify the patterns or the biases or the mistakes you are making. And you will keep repeating the same mistake. The thing is, once you go through these, you will know, okay, that these are the problems that are out there. Then the next step is you have to identify that within yourself and in others. Just reading will not obviously do anything. Just like, just reading a fundamental book or a technical book is not going to help you. I mean, you can read any number of technical texts, but if you don't go through 100 charts, it will not help you. Similarly, you can read any number of investment books, but if you don't go through 100 annual reports and 100 balance sheets, and if you don't go through the process, it will not help you. Similarly here as well. But this, unless you understand that, okay, what is incentive cost bias, or what is, price anchoring, you will not know when you are falling into that trap.
Dada, can you suggest, like, if I have to ask you, I want to start with some of the books on investing psychology. What are the top 2 books you will, suggest to start with out of this 9?
You start with Poor Charlie's Almanac and The Disciplined Trader, 1 and 9.
1 and 9. Okay.
Poor Charlie's Almanac is slightly expensive, but you make a lot of money, so you should buy it. And Disciplined Traders is a trading book. But again, if you replace the word trading with investing in your mind when you're reading it, it works equally well for a trader as well as an investor.
Okay. Thanks a lot, Dada. Thanks. So I think this is what I had, and I believe the session, the content, the learning which you have shared, it is super useful. There is a lot to learn from the experience, your journey, as well as some of the resources you have suggested. So I hope this video was useful for you, and we have given a lot more resources in terms of what Dada has covered in terms of his journey, his value picker threads on some of the systematic investing. Everything is there in the description box. Do make use of it. And thanks again, Dada, for your time. This was super useful.
Thank you, Saurabh. Thanks for having me.